Welcome back, chart addicts, to the Expert Trader podcast. Last time that we sat down with this individual, we had the highest viewed podcast that we've ever had. It's my pleasure to welcome him back on the podcast. Ted, welcome back to the Expert Trader podcast.
Thanks for having me again. I guess either people couldn't finish it the first time they listened to the podcast, or I was actually popular. So Thank you for having me again.
I'm going to vote for number 2. I've seen the podcast. I've actually seen that first podcast that we did about 3 times. I had everybody on my team watch it. It was extremely useful. If you guys have not already seen that, click the link below. We'll go ahead and include that in the description. Last time we talked a little bit about Ted's strategy. We talked about brokerages. We talked about mindset. And then we talked about tips for new traders. This time I want to shift directions to things that are a little bit more relevant. So the first things that I want to talk to Ted about: funding. I want to talk to you about algorithms. All right. So we're going to start off this podcast, and then we'll go through something a little bit deeper in psychology later.
Yep.
So what is your experience with funding? How do you view funding? Should traders get funding?
Okay, so there's 2 trains of thought here. The first train of thought is, when you look at funding, where is that funding source coming from? A lot of people lately, like you've said, have jumped onto the bandwagon of, hey, I have a $100 account. I'm not really making money, but if I pass a series of challenges, I can now be funded for whatever amount there is. And truthfully, I don't think that there's anything wrong with that. Where I take sort of a challenge to, or I sort of am skeptical, is who's putting up this money and why are they putting up this money in this way? When we look at how a prop firm works, so back in the early 2000s, there were many prop firms. So essentially what they would do is they would bring you into their office. They would sort of take anybody that they could. Prop firms were notorious for just pulling anybody off the street, because really you could teach certain skills, but you can't teach other skills, right? So people that were natural risk takers, people that have, backgrounds maybe in psychology, people that, they're just less risk adverse. Those were good candidates. People that were aggressive, people that, salespeople, so to speak, right? They don't take no for an answer. So what they did is they would look at your personality and then say, okay, we could probably train this person, give them sort of the tools, and then they could attack the market. And, once again, we would then chop up the profits, and so to speak, in terms of that. And it was a similar split, like 70-30, 60-40, whatever the split was. But that was a regulated establishment. They actually had a fund. It was usually led by other traders. And those traders were saying, hey, let's build an army. Okay. And they did that. There, you can Google it and you can see that there were a lot of prop firms out there. The other item with prop firms was they scaled you into trading, right? So they would start you off with $1,000 account or a $2,000 account. This is trading stocks. And they would say, okay, once you get to 3,000, we will add $500 or $2,000. There was always a scaling amount. There was never, hey, once you pass this, now we're just going to give you a lump sum of money to go ham with.
I see.
And then there was also parameters involved, things of that nature. So to say that funding is wrong, that's not where I would disagree. That's where I wouldn't agree. I wouldn't say funding accounts are wrong. I would say the transparency around how they're being funded is a little to be desired. Okay. And I think that's where we have to start as a community to accept that, because a lot of comments, and you've probably read it as well, is like, well, I don't care where the money's coming from as long as I get paid. And that's an ignorant statement, because there are a lot of potential pitfalls with money coming from illicit sources, you being involved in generating funds with those illicit sources. And I don't think the community is educated enough in AML, into anti-money laundering laws, know your client laws, to make a valid discussion. And I think that's where it comes down to. So do I think funding is wrong? No. I think the approach has to be adjusted, and there has to be more transparency around that approach. Not, hey, let's throw you on to an account for 2 months. If you pass a series of challenges like a video game, here's some more money. I don't think that will breed success, because you're not changing the habits of people. What you're doing is you're forcing them to do something to get a carrot, and then eventually they fall off the bandwagon again.
Okay, so you think so for somebody who actually doesn't have the discipline or the self, I would just call it the discipline to be able to handle that account. You think it's more destructive to have a larger account?
100%. I mean, and that's where I think, where we don't have the transparency. Everybody turns around and says, well, if I had $100,000 account, I would be a better trader, right? Like, I think you've heard that as well. Like, that's the first thing that everybody says is, like, if I had more money, I would be a better trader, because then the money means something to me.
Sure.
And the issue with that, and where I take a more critical stance, is what happens when you take a loss, right? So everyone talks about the positives of, hey, if I have $100,000 account or a $50,000 account, whatever it is, when I win money, it's going to be good for me, because 10% of 50,000 is $5,000, right? And a lot of people in today's day and age would say, hey, 5,000 a week or 5,000 a month, that's pretty good income.
Sure.
But then what happens on the opposite side of the coin when you have a losing day and you've never lost $1,000 in a day or $1,500 in a day? That's going to set you back a bit, because 100%. You're not used to handling that size of an account. You're not used to the swings of that account. And those swings, you get comfort based on as you run your account up, as you move up, I guess, quote unquote, levels or stakes, right?
Yep.
You go from $1,000 account to a $5,000 account. You've handled the swings in between there of losing $100, winning $300, losing $200, and you've become accustomed to that. So to drop somebody into the deep end and say, hey, here's a $50,000 account, when you've been trading $100 accounts for the last year, it's a mindset shift. And there's nobody that can train you to do that other than experience.
I see.
And it's similar to, like, if you were a high school basketball player or a high school football player, the jump from high school to like the NFL or the NBA is huge. There's only a certain amount of people that have ever done it, right? You can count on one hand the amount of people that have jumped from high school successfully into the top sports, the top athletic agencies, the NBA or the NFL, things of that nature. There's a reason, because there's a natural progression in a lot of things that we do in life, and it tunes you for as you get to that elite status, right? Yeah. People play in the NCAA and then move into the NBA. They still have to train hard as they progress from the NCAA to the NBA, but there's a graduation there. You're playing amongst the top level each time, and then you just move up to the next level. You can't really jump from high school to NBA and be successful. It's very rare. We've had, I think, 3 people in the last 20 years do it. So that should give you some sort of statistic, right? When you think about it, I mean, maybe there was 5, I don't know. Like, people are going to come back and give me the exact number, but like, think about it. It was LeBron James, Kobe Bryant, not even Zion, because Zion did, I think he did a year of NCAA.
Yep.
Before he moved on, right? So when you look at that, I mean, those are the people that come to my mind. There's probably others that have jumped straight from, high school to NBA, but I'm saying the numbers aren't there. So that's where I think there's also a gap in the way that we approach these topics, is everybody looks at, well, yeah, I can do it, but we don't look at the total statistics of who's actually done it. So when we look at funding, that's the other thing that I'd want to look at is, well, how many people actually do succeed at this? And if the succession rate is so low, there's obviously a problem with the graduation rate, right? So look at it this way. If everyone in your high school graduates with a 90% average, and then they go into college or university and then they start getting 60%, is there something wrong with the university, or was there something wrong with the way the high school was being run?
Wow, good question.
Right. So those are some of the thought-provoking questions that I ask. So if you have a funding team or you have a funding company, and the funding company is saying only 6% of people succeed, I mean, is that really a good track record? Like, as an investor, and I see that statistic, am I really happy about the fact that, hey, I have my money in this funding company, and this company is telling me only 6% of people are actually going to make it to use my money? And then out of that 6%, how many people are actually going to make me money?
So
Like,
let's set aside. So
yep.
assuming the legitimacy of the funding company.
Mm-hmm.
So let's
Yep.
assume that they've been properly screened and the individual has done their due diligence. We're going to ensure that this is a reputable company. How does somebody, if we can use the basketball analogy, how can somebody know if they're ready to go from NCAA into the big leagues? You know, is it just a matter of taking the leap and then assimilating after, or is there a moment that you're like, okay, I've done this consistently long enough, it's about time for me to make that next step? How should people be thinking about taking that next level in their trading?
Well, I think what it comes down to is it comes down to the experience, right? So when you're trading a smaller account, if you're barely having success with that smaller account, why do we think that there's going to be success with the bigger account? So that's the first thing that I want to look at. I'd want to look at overall, why am I doing this funding to begin with? And what is my track record to give me the impression that this funding is for me, right? Because
Sure.
I guarantee you a lot of people are thinking about this and they're saying, well, I trade a $500 account, but then I ask, well, how many times have you blown that $500 account? Maybe 3 or 4 times. Do you think you are properly educated or experienced enough now, even if you do, I guess, quote unquote, fluke the qualifications and you have a good week or 2 weeks of trading and now you're given a lump sum, are you doing yourself a disservice because you're not being totally honest with yourself? So maybe you as an individual should have a better track record of maybe 6 to 8 months of success. And I'm not saying that you have to run an account up from $500 to like 10,000, but are you able to maintain consistency? Are you able to take, say for example, are you able to take the parameters that they've given you to be successful to pass this, funding test, right? So if there's a funding company out there, they give you the qualifications. Are you able to take those same qualifications and mirror them on your current account for the next 6 months?
Mm-hmm.
Right? So like, how successful are we at following our own rules? Because the other argument is, and you'll hear this too, you'll say, well, Roy and Ted, like I can do this because they've given me a set of rules.
Mm-hmm.
Okay, so then you should be able to do this on any size of account.
Exactly.
Right? So there's the opposite argument. So there's where people, they're going to come back and say, well, they've given me a set of rules, I follow these rules, I should have no problems with risk management. I 100% agree.
All right.
Like, if you can follow a baking plan, if you can bake a cake and follow the rules, you can bake 100 cakes.
For sure.
It's what happens after cake 50 when you're exhausted from baking 49 other cakes. Suddenly you take a shortcut. Oh, I don't really want to do that today. Oh, I see this opportunity here in the market, I can grab this. Oh, whoops, took a loss.
Yep.
So
right.
I think that's what you can do. From a funding standpoint, funding companies, you have full transparency. If you're able to duplicate or replicate their rules over your own account for, say, 4 to 6 months before you actually go attempt that, I think you'll have a better leg up. Because this, I don't think the qualification period is long enough to give people an accurate view of how they will perform overall. And I think that's what we have to be careful of, is the longer that you actually practice that risk management model, the better off you're going to be when you actually get the funds that are going to be given to you once you complete whatever requirements are from whatever fund company that you're working with. I think that's the key as a trader. If you're looking to get funded, work with the set of rules that you would be working with a $100,000 account. Do it on a $500 account and see how you fare. Are you able to mentally do the same thing over and over every day, every week, every month?
You guys heard it. Step one, find the legitimacy of that company. Make sure you guys are not just going with any willy-nilly, anyone who's offering money. See if there's a backstory, figure out where the company's legitimacy comes from. Are they in a specific area? Are they regulated by a specific industry? Figure something out. The second part is your preparedness. If you guys can do it on a smaller account, you can show yourself that consistency, then you guys can end up replicating that on a larger account. Ted, appreciate that insight. Let's move on to something else that's been getting thrown around a lot in social media, which is algorithms. So every other company now is coming up with some kind of algorithmic trading. We'll trade this account for you. What's your experience with algorithms? How do you view algorithms? Do you use them? And if you can just walk us through your perspective on that.
Yeah, so I think with algorithms, we have to be very careful. I don't think that there's a problem with algorithms. What I think is there's a problem with the perception of how the algorithms will perform. And I think there's a disconnect there within the community. There's no doubt in my mind that there are algorithms that are profitable. But the question remains, and it's more of a statistical probability, is that algorithm going to generate 10,000% over the next year? Chances are they're probably not. So once again, it's more of a mental game when we look at algorithms and we say to ourselves, okay, I want to invest in an algorithm. So we've seen that on social media. This algorithm performs and it's done 10% a month. It's done 30% this week, whatever it's done. The due diligence now comes on your side. And I've spoken about this several times in other things that I've posted on social media, is who's running the algorithm? What qualifications do they have to generate this algorithm? And then what liability are you willing to assume if you use this algorithm? So as an example, I've seen probably 5 or 10 algorithms on social media. I've taken part in some of them, but what I've always kept in mind is who's running the algorithm? What kind of education do they have? And can I figure out how the algorithm's actually working so that I can take advantage and sort of hedge myself in a way that, I'm not overly exposed in the market? A lot of people don't do that because the algorithm is, I guess the sales pitch is, well, you just deposit money, the algorithm is going to do its thing, it's not going to lose. We have the proper risk parameters there, and you're just going to make money hand over fist. And I mean, the age-old adage, if it's too good to be true, it probably is. And this is a perfect example. No algorithm will run indefinitely without failure. There is a failure rate for every algorithm. It's how does the person running the algorithm adapt to the changing markets. So if a person that's building an algorithm is, a qualified trader, they're a qualified programmer, and they're constantly tuning the algorithm,
Yep.
then you should have no problems with the algorithm generating a consistent return. Your job as an investor in that algorithm is to manage your funds accordingly. If you deposit $5,000 and the algorithm does 30 or 40% in a month, you should start looking at taking out most of your initial capital to protect yourselves from possible headaches. So as an example, I was in an algorithm that blew, I would say, every account that it was trading because it was trading during a time of Brexit. And what ended up happening was it was in a trade where this algorithm works on a grid scale. So it's almost like a martingale approach, where what the algorithm does is it doesn't have a stop loss. But what it has a level, it has levels. So as it trades, it starts off with a small lot size that it opens according to your account. And as that trade goes into drawdown, it opens up another position a little bit bigger than the previous one, so creating a martingale effect. But what it does is it moves your take profit down with it so that eventually it averages out so that you gain a bit of money, right? So everyone thinks that's great because in 1 month the algorithm will do 40%. So it'll do a drawdown, and then scoop everything back up. The problem is when you get to level 6 or level 7, you are now in a very, very heavy drawdown and you've opened the largest position that you can with that algorithm. And if that algorithm doesn't turn around, you blow your account.
I see.
Right? Because it's worked on a set of parameters on a base of price average to say, hey, price can't go down this low or price can't go up this high. Eventually it's going to turn around and we'll catch the tail of the turnaround and we'll close that position out. Well, with Brexit and any other major fundamental event, it didn't happen. it just kept moving. Like the pair just kept moving in one direction. It would retrace, but the retrace wasn't big enough for the algorithm to close out. It just missed it narrowly by, I think it was like 0.5%, and then took off again. So I exited my positions when I saw that happening, because I could see on the weekly chart or the monthly chart that this was not moving anytime soon to the downside. I was reprimanded by people that were running the algorithm saying, let the algorithm run. You shouldn't have closed it out, blah, blah, blah. And I said, what? The risk that I saw was not healthy for me. And because it had no stop loss, I wasn't healthy with this. And that was my experience with that algorithm. I'll never use those algorithms again.
Mm-hmm.
The algorithms that I've always used have stop losses. They're properly managed. They work on just a couple of pairs, and they're a little bit more conservative. So
Mm-hmm.
you're never at a full exposure that some of these larger algorithms are. And I think that's the issue with a lot of the FX community, is people that are programming algorithms aren't necessarily financial programmers by nature. They may be taking algorithms that they found somewhere else. They may be rudimentally programming algorithms just because of their basic coding knowledge and basic trading knowledge. And eventually, if they don't monitor them, they do blow up.
So
So
are
I
these
think,
algorithms only, I didn't mean to cut you off, but
yeah,
are these algorithms only as effective as the information that they were programmed with?
yeah,
So,
essentially that, and also who's doing the programming.
okay. So the
Uh,
credibility of the programmer, and then like how effective that information is. And so what about if market cycles change? So if they set
right.
the algorithm, can they go in and just change it?
Yeah, they should be. This is the thing. If you look at institutions, if you look at institutions on Wall Street, the biggest fight that they have on Wall Street is two things in the equity market: latency and programming. If you want to be the best in Wall Street, your latency has to be super low. So that's why, if you look, a perfect example, I don't know if you know this, the Nasdaq, where it is in New York City,
Mm-hmm.
around it, there's two buildings that are just full of servers,
Oh yeah.
right? And
Yep.
the reason for that is everybody wants to have the quickest, fastest connection, and people pay millions of dollars to have the best connection, because that's the make or break setup, right? Because
Yep.
you have low latency, you're the first one to execute at the best price, you beat out everybody else, and that could be the difference between 1% profit and 2% profit. But then you say, okay, well, that's not much. But on $1 billion,
Yeah. To them,
on
it's a
$10
lot.
billion, it adds up.
Isn't that a little archaic to still be running on fiber optic networks?
Well, I think that's what I think that's what it'll always be until there's something out there that can beat it. I think the hedge fund industry or the institutional industry is still a little bit on the old hand. They are improving, and you see that now with algorithmic trading. They're hiring more quantitative traders. The old school reading the tape, or the old school, like, hey, knocking on doors, like, you look at Billions, right? Billions, the TV show. I'm pretty sure anyone that follows your podcast probably has watched Billions. If you haven't, I would watch that, because you have the exact same thing that we're talking about right now happening in that show. You have the old school, Bobby Axelrod, who knows the players, who knows the companies, who can foresee things happening. And then you have Taylor Mason, who's the quant, who does everything from a mathematical side and says, hey, this is the way this is going to happen by human engineering. We can get an edge on this, on the numbers. And Bobby's saying, no, I can get an edge on this based on looking at what the person is doing and who they are as a person. I can make an assumption based on that, because he's the old school trader. So you have two trains of thought there. So as we shift into more quantitative trading and algorithmic trading, the fight for latency and the fight for new ways to execute trades and to have those vetted is very important too. I mean, there's
That
companies now that make money just on the way that they vet your systems. They'll go into your system and point out all the potential flaws, and they get paid to do that.
is there a centralized network for the foreign exchange market?
Nope.
Is there a centralized quotation system?
Nope.
Is
And
there?
that's the problem with FX. Unregulated, decentralized. It's the Wild West.
Jesus.
Yeah.
Okay.
So that's the difference, right? So that's where, people use, we always talk about COT reports or volume indicators.
Hmm.
Volume of what? We don't know where all this volume is coming from. We don't know. We don't have access to information. The only way you have access to that is if you're working at a prime broker level or a prime bank level to get that data. But you're now playing with 20 to 50 million dollars, and at that point, it's only with the counterparties that you're working with. And to be honest, the latency issue at an FX level isn't as grave as it is at an equity level.
I see.
You can still get away with having, poor latency on an FX level, and it's not going to hurt your bottom line just because of the way that how fluid and how diverse FX is compared to equity markets. The equity
So a
markets are,
currency is less time sensitive.
yeah. And but the thing is though, expect that to shift over the next few years, because what's going to happen, and we sort of see it cycles with the equity market and the the futures market and things of that nature. It's getting tougher and tougher to beat the market to get an edge to make money. So where are these firms going to start moving to? They're going to start dabbling more and more into the actual execution of FX instead of just using FX as a hedging tool against other instruments. You
Wow.
probably see banks start trading that, because as they get better and as they build software that can manage that, it'll manage their risk. Because the reason why banks and institutions don't touch FX is because there's too much risk exposure,
Yep.
right? There's too much manipulation. They can't control that. Whereas in a equities market, they know who the big players are. They can figure out, who's moving what. They can make adjustments accordingly, and it's a centralized market. Everything there is regulated. There's some sort of control, even though you have a couple of fund managers that could probably move the market. You look at, like, say for example, like Warren Buffett, right? Berkshire Hathaway. They turn
Mhm.
around and close out all their airline holdings. Everybody starts to panic and follow suit. There wasn't manipulation there. It was Berkshire Hathaway saying, "Hey, we don't want to be a part of this anymore," and every other fund manager going, "Well, what do they know that we don't? Okay, let's dump too. Like
Yep.
we'll just do that, and then we'll pick up the pieces later." So that's where you get that market movement. Whereas with FX, it's the Wild West. We don't know who's deciding to manipulate the cable today, and what algorithm turns on after that algorithm turns on, and then it starts to spiral out of control, and that's where you get those flash crashes.
All right.
So
Wait.
it, yeah,
That I really don't want to cut you off. There's so many questions here. So
yeah,
in the
go.
United
Sorry.
States, the SEC has laws against manipulating the markets,
Hmm.
but that's for equity markets. So there's no
Hmm.
pegging, there's no churning, there's
Yep.
no
Correct.
so you know that stuff. You probably have it in Canada as
Yep.
well.
Yep.
So since you're saying that the forex markets are unregulated, you're saying that there is no law stopping anybody or any institution from pegging the price or
No.
from. Okay.
No, there isn't, because I mean, when you think about it logically, right? If I want to buy X amount of dollars, I want to buy X amount of US dollars, I just go in there and whack it. Like, I just do that. I mean, there's the COT reports which talk about larger institutions moving money, but as well as I do, there's dark pools of money that are off the exchange that make trades, right? So like when we talk about dark pools are off the exchange. They're used by other institutions to have transfers made that are recorded, but they're not recorded on the exchange. They're recorded off the exchange. So it's almost like when you look at Bitcoin, right? So if we were to look at Bitcoin, so Bitcoin has, like, argument's sake, 10 coins. There's
Hmm.
10 coins available. 5 of them are trading on the desk right now on the over-the-counter market, and 5 of them aren't. If I don't want price to be adjusted, I will sell those 5 Bitcoins off the market, give them to that other bank or that other person, and that has not affected the price of Bitcoin because they're not technically on the exchange. So when we look at dark pools of money, that's what's happening in sort of the equity markets. I mean, once again, you watch Billions, it's exactly what it is. It's like, call this company right now and get them to dump those shares. They run that company, but it's not directly that their own company that's making that trade. It's the other company indirectly doing that. So now it's a game of cat and mouse. On the FX side, it's like a free for all. Like, you can do whatever you want. I mean, there's the old, if you look up on the internet, it's called The Club in London. in the UK, which is, where the biggest exchange is, there was various reports over the years that top traders would go there and meet, or they would text each other, and they would move the market because they were able to move price based on what they were buying and what they were selling. And it only got basically caught, I think, when it became blatantly obvious and someone actually did an investigation. But if you read up on the club, that's exactly what they were doing. So
Is this why they got off LIBOR?
yeah.
Oh my
So
God.
when you think about it, right? If they were able to catch one group doing manipulation, how many groups haven't they caught, right?
Under the radar.
Yeah, exactly. So I mean,
so
it's
Ted, let's talk about structure. Okay, so let's take this a completely different direction then. Let's talk about structural problems within the actual FX markets. So since there's no centralized systems, there's just small exchanges, or I guess there would be like large exchanges in different places.
Yep, that's basically what it is. I think because it's not as prevalent, the barrier to entry is all over the place when it comes to equities, because equities are actual companies, right?
Right.
Equities are actual like companies, where dollars and the pound and whatever, the euro, those are instruments, those are banking instruments. And I think to try and control those banking instruments, you would need a lot more oversight. And I think really at the end of the day, there's people watching, and they're just making sure that it doesn't go too crazy, so to speak. I mean, that's a very, very basic way of looking at it. But
Right.
I mean, you do have the the CFTC and the NFA for the US jurisdiction. I mean, we have the FCA for UK. There's the ESMA for Euro. So there are regulatory bodies that do that. And they are looking at it, but it's such a vast array. It's all over the place, that I think it would take a lot more structure for them to rein everything in. And I don't think they have the manpower, to be honest.
So
And I think it's
we've
sorry.
seen we've seen risk parity funds, and we've seen hedge funds take markets past levels where they naturally should be. So the oil crash and the equity crash, for example. So that wasn't general market movement. That was kind of like traders taking the market down. If that
Well,
happens,
it
currency.
was yeah, it was basically people that weren't able to, they didn't want their contracts anymore, and they're like, no, you need these contracts, and they were trying to offload them. It's the same thing with FX, right? FX are, you're buying $100,000 contracts to take on that money at a certain leverage. Algorithms could possibly blow the market out. Like, I mean, it's very, very possible that they could do that, because there's really no circuit breakers on FX.
So that's my question. So if that gets bad enough, if there's an instance where there's some sort of flash crash and there is no circuit breaker on a specific currency and hyperinflation happens, will the FX markets then get regulated, in your opinion? Do you think that that's the point
Yeah,
where
I think
somebody will step
I
in and be
think
like,
I think it's already started, to be honest. I mean, we had the flash crash with the Swiss franc. We've had the yen the other year. We've watched these things happen. I mean, they're so fast and so quick. I still think that there is regulation coming in. And I mean, to be honest, if you look at the education, or you look at what's out there for FX, that is a perfect model, or a perfect, like, 10,000 foot view of the FX market. Everybody can teach FX. Everybody's involved in FX. So now when you look at the market, are you surprised that the market is as crazy as it is? Look at the people that are trying to promote that. When we look at the equities market, it's totally different, right? You don't have people on Instagram talking about, hey, let's buy and sell stock today. Let's do a webinar on how to buy stock, because it's not glamorous. Nobody's doing that. It's too hard. I don't know what stock to pick. There's so much work to be done. FX is like, hey, load up an MT4 and MT5 and get to work.
right?
So when we look at that, those are sort of the parodies that I see. And it's like, well, I just look at who's talking about FX, and I can see why the FX industry is all over the place. Because I mean, you have 21-year-olds telling you that, hey, this is your financial future available, and like, just deposit $500 and next week you're a millionaire. You don't have that in the equities side, because obviously you have to be registered to sell equities, to educate people. There's a whole lot of there's a lot more consequences on that side.
Yeah. All right, so let's put this into application. That's a lot of great information, guys. If you guys are watching at home, go back and re-listen to a lot of that. Some of it might go over your head. Don't worry too much about the structural stuff, but just figure out, okay, who am I playing against and what are they really trying to do with the markets? So Ted, that's kind of where I want to shift the direction, which is let's talk about how to think in terms of your opponent. So the quote that really came to mind was, and this is because we talk a lot about poker references since you're kind of like the poker reference king. We'll go through a good player plays based on his own hand. A great player plays based on what he believes his opponents might have. And so let's kind of take that into trading from like thinking as your opposition, or I guess, the banks or whoever you're trading against. How can a trader start to think from that perspective instead of their own perspective? And how may that help them in actually, moving with the direction of the market?
Perfect. Okay, so that's actually a really good way to take a high level view of your trading. A lot of people are executing based on technical analysis, based on trend lines, based on support and resistance, supply and demand, you name it, they're using it, right? So we see the internet flooded with all this education about how to trade. And that's fine. I mean, there's no problems with that. And I'm the first one to say this. Like, if you find things that work for you, that's perfect. But now dive into the psychology. Why are those things working the way that they're working, right? Because now there's obviously a counterparty. There's someone taking that side of the trade, right? So exactly to your point is, what is the institutions doing? What are the governments doing? Who my opponents are, what are they doing and why are they doing that, right? So we can look at a chart, and I would use, say, the weekly time frame or the monthly time frame as an example, and just from a high level overview really fast, mark up your highs and lows, right? And what does that tell you? You can go, let's take the US dollar CAD for an example, because we're in North America. US and Canada are the biggest trading partners, right? So they're each other's biggest trading partners. Sure. So we know that. And if you don't know that, this is something that you have to learn, because now how do institutions evaluate that? Well, it's very easy, right? If the Canadian economy is doing well, people are going to be buying the Canadian dollar. The Canadian dollar runs off of, say, oil, off of resources, things of that nature. The US dollar runs on, manufacturing, trade, things of that nature as well. There comes to a point where the US dollar or the Canadian dollar becomes overvalued or devalued. And at that point, it becomes either too expensive or it becomes too cheap to actually do trading with, right? So you have an imbalance of trades. It's an economics idea. Sure. So when you look at your weekly and your monthly time frames, you'll probably see there's certain parts of the year where we have the biggest discrepancies, right? So as an example, usually in the summer months, the Canadian dollar gets a little bit stronger. Reason being is people drive around more, they consume more oil, we produce more oil. So there's always a balance. So if you were looking at your higher time frames, you would see that the dollar fluctuates between, $1.25 to $1.35. It's like a 10-cent spread usually, right? Now we're at $1.40. Because of the fact that the Canadian dollar is taking a hit, oil prices really dipped. So, Canada's really hurting that way. So there's an imbalance now. But if you look at that theory and you think of your opponent, you're going to get to a point where I look at my opponent and I say, man, the euro is way too low. The pound is way too high. It doesn't mean that suddenly the economics of that country makes sense. But from a currency standpoint, it's not helping the country anymore. There has to be a rebound. And this is where people get confused, because they'll say, hey, the UK is in turmoil right now with Brexit. So the UK pound should be at like zero, just for hypothetical sense. But we can't have the UK pound at zero, because it would be detrimental to trading with other countries, for doing commerce with other countries. So when we start to think of our opponent, we have to understand that at a certain point, price is going to reach a high or a low that doesn't make sense anymore. So if you're able to keep that in the back of your mind, and think about what your opponent's doing and why they're doing that, it gives you a little bit more sense of what's happening in the FX world, right? So I always use the US dollar, Canadian dollar as an example. When the US dollar is at $1.42, $1.43, that's very high to trade with Canada. It will make our products here in Canada very cheap for them to buy. But then that hurts us as an economy because now we're not able to, we're going to sell more, but we're making peanuts on it. It's
Yeah.
costing us so much to send to the States. Like, you know, suddenly now a loaf of bread, we're making basically nothing on it, right? But at the opposite end, we can't have the US dollar super low because now that creates a trade imbalance with the Canadian dollar, right? So if you keep that in mind and you understand what your opponents are doing and you map that out on your technicals, you'll see at a certain point that, hey, we're at a really bad level right now. This is not a level that I want to trade on, but I can see now that once we break out of this level, we have a very easy ride to, say, you know, another major part of the chart. So you can anticipate that, and what you can do is, as a trader, you can say, okay, you know, say for example you're trading the pound yen, right? You're trading GJ. GJ is now at $1.31 or $1.30, right, or 130 or whatever it is. You know that that's a very low rate. You look at the weekly charts, you can see that 145 is a very high number. So you know that as we start to creep up, if we get into 133, 134, we could probably get to 137. And if we get to 137, we could probably get to 140. But as we get to 145, I have to put the brakes on because we haven't seen 145 a lot. And when we see 145, it gets rejected a lot of times. So I don't want to fight in that channel. I want to leave 145, either go up to 149 or say from 145 back down into 142. So now I can start to map out my levels of where I believe price can move based on the fact that, hey, this currency pair, it's too cheap or it's too expensive from an institutional side. So I know my opponent is eventually going to create a supply level or create a demand level and instantly reject that area. I mean, you can look at the chart. Everyone can open up a weekly chart on GJ. You can see massive rejections and massive rejections on the high side, and you can see they drive all the time in a wave pattern. So if you can anticipate that, you can get out of the way, and then as soon as we have that rejection and we have, you know, confirmations of moving away from that area, you have nice easy trades because everybody's now leaving. Everybody's gathered the price that they needed at that level, at an institutional level, and is now moving away from there, and it economically makes sense.
Ted, you've answered every single question I had about that entire segment. So about how they move it, about the higher time frames. So then let's talk about something on a macroeconomic perspective, since we're talking about how institutions move the markets.
Yeah.
So how do you think that quantitative easing, since it's happening in so many countries, and since there's been a pledge of unlimited QE if they need to, how do you think it's going to affect the currency markets? They just keep adding currency to the pot, or some countries going to get devalued? How do you think that plays out?
So I always say this. People ask me this question all the time. If we have hyperinflation or we have those things, we have bigger problems than the FX market.
I see.
That's what I always tell people. And people ask me, because like lots of people ask me that question, like, well, Ted, what happens if the Fed keeps pumping trillions of dollars and then, you know, there's this enormous debt? I'm like, well, you don't have to worry about trading FX. You're going to have to be worrying about buying a loaf of bread at like $1,000 a piece, right? I mean, maybe it's not going to go to $1,000, but we have bigger problems, right? I always say that to people. And this is the issue that we have. And what institutions have done in the years, I mean, they're saying, if you read about it, it says don't bet against the Fed, because institutions used to bet against the Fed, right? Because they would say, well, we can't carry this much debt. The Fed has to do something. They have to change something. And what does the Fed do?
Wrong.
Yeah, exactly. Boy, we're wrong. They pump more money and it blows the stock market up. Like, look at what's happening with the, you know, everyone's trading US 30 right now. The US 30 is at like 24,000. So the Dow Jones is at like 24,000 points. Yep. And we have record unemployment in the United States. We have record companies closing. We have turmoil. We have a virus that's out of control. And yet the stock market is like talk about having a house on a street where every other house is burning and you're sitting inside your house going, well, my house is fine. I can't see my house catching on fire. Meanwhile, the whole street's on fire. Like what? Your house is made out of cement. Your house is eventually going to catch on fire. But nobody wants to admit to that, because if they do that, that will create chaos. I mean, the conspiracy theory is that the Fed is run by obviously big business, and big business is like, hey, don't worry about this. We'll leave this to the next generation to figure out. We'll live our life now. We'll make our money. We'll live good. And the people that are, 5 and 6 years old right now will wake up in 20 years from now with, like a 10 or $12 trillion debt, and we'll be like, well, we're dead. We don't care. We enjoyed our lives.
Yeah.
So that's the bigger issue.
I personally, I don't think it's that malicious. I really just think that they think that they're smarter than they actually are, and the fact that they can engineer the economy. But I saw this on Bloomberg. JP Morgan threw out I think it was JP Morgan or Bank of America. They did like the past 50-year study showing the dips and the recoveries in the stock market and the correlation between Federal Reserve action. Yeah. So it just coincided. Every single time that they took action, there was a recovery in the market. Every single time and that's kind of what's been leading to this artificial growth. But I appreciate you walking us through the back end stuff. Now, if there's one thing that I'm really curious about, and I feel like after having discussed the entire scope of the Forex market, let's see if we can sort of codify this in a way that's really simple. How would you say the different tiers of liquidity are in the Forex market? Like where does it flow from, and where does it all the way down to the retail trader? Do you think you could do that?
Yeah. Okay. So let's talk about that for a second. Let's break down the flow, so to speak, because a lot of people, they blame their broker every day when there's slippage or whatever it is, but they don't necessarily understand how the market works. So the central banks and what we call prime of prime, they issue currency, right? So you have the Fed, Reserve, blah, 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 the central banks, IMF, things of that nature. They control monetary policy. They basically peg the price of the dollar, so to speak. When we start to move, it becomes almost like a supply chain, right? So if you learn in economics, the added value, right? So if I buy a shirt from a clothing manufacturer, that shirt probably you can buy for $5. Now, if I slap a Nike logo on that shirt, suddenly that shirt now is worth $15. If I now have an athlete sign that shirt, it's now worth $30. So there's an increase on that shirt, but it's still at the end of the day a shirt. It's the intrinsic value that we assign to that. So now when we bring that to FX, we have the same sort of idea. So we have the prime of prime banks that provide the funding for everybody, right? So that's where you go. If you think of it like a storefront, the prime of prime are like your Alibaba or your Amazon of currency, right? Everybody goes shopping there. And then what you say is, okay, well, how come I can't go shopping there? It's because you don't have the threshold or there's a barrier to entry there. You need like $100 million, $200 million. You need to be able to, you basically need to be a bank, so to speak.
I see.
So now we move the next level. So now we're a prime bank. So the prime banks are your JP Morgans, your Citibank, your Barclays, your Credit Suisse, your big, huge banks, right? Because they work directly now. And their job is to send out money. They loan money in mortgages, they investment in businesses, they send currency out, yada, yada, yada. They add their spread to the original price because that's how they make money. They make money on the spread. Now, that money goes into your liquidity provider pools, right? Because when you go to a retail level, like we've talked about earlier, in the previous podcast, is retail flow is a mishmash of strategies. So when you're on an institutional flow, you have a set strategy. So you work with a prime bank and they execute for you. Like they execute with you. You get the best possible spreads. You get the best possible execution because they're directly connected with you. You're like a partner. When you go to the liquidity provider side, a liquidity provider is almost like a ticket broker, so to speak, right? So like, you ever want to go to a concert, you want to go to a baseball game, the tickets are sold out everywhere. You go to a ticket broker, he magically has all these tickets available. right? Because he knows somebody in the organization. He has people that are season ticket holders. So he's grabbed all these tickets and he's constantly unloading them. That's your liquidity provider. So your liquidity provider is an organization that goes to all these prime banks and basically sells them on a dream, so to speak, for lack of better terms. It says, hey, I know that you're getting the euro dollar at this rate. I know you're getting the pound yen at this rate. I know you're getting all these currencies at this rate. I want to buy them from you at your rate, and I'm going to resell them to retail brokers, retail platforms, smaller banks with a spread attached to it. But don't worry about execution. Just make sure you can fill the orders, because it's going to be a whole bunch of garbage coming at us. We're going to have swing traders, scalpers, EAs, algorithms. We're going to have everything coming at us. So I'm going to mark up my spreads accordingly to protect our investment, because the liquidity provider has an onus to the prime banks to make sure that they don't get screwed over. I mean, it's money. At the end of the day, nobody wants to lose. So they add a spread. Now, the retail broker receives the liquidity provider. So the liquidity provider, I get this a lot of times. Someone will randomly email me, to be a liquidity provider. It's a company. Hey, we can give you spreads on these pairs at this price, this execution speed, yada, 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 fill rates at 99%, whatever it is. You want to sign a contract with us.
Jeez.
And it's a scale. So what it'll say is like, hey, if you do 1 yard, 3 yards, whatever it is in terms of flow, it will charge you this per million.
Wow.
And that will go up or down based on the flow. So as a retail broker, we look to see where we're going to get the best price for our flow. So what you'll do is, it's all relationship management. So I've gone through a couple of liquidity providers. Now I have a really good one. And it's like, hey, I will try to get you this much flow per month. This is my average flow. I can do the calculation based on looking on my aggregator. I can say, hey, this is the money that's being traded or on volume every day in my platform. And over the month, this is the total volume for the month. And understand this, and this is the misconception. It's not your $500 account. It's not your $200 account. It's the total volume of my brokerage. So it's, if someone's trading Euro USD and they're trading 0.05 a lot, it's combined with everybody that's trading that. So there's going to be people that are going to be buying the Euro USD, and there's going to be people that are selling it. It's the total volume going in. So when people say stop hunts and this and that and the other thing, it's like, no, because there's always people buying and selling. There's always people on both sides. It doesn't matter. Like if I was to go through and ask my tech team to pull up, the volume analysis, there's always 10% of people selling Euro USD, and there's always like 90% of people buying it, or vice versa, because there's people with different strategies, right? So that flow just gets pushed up to the liquidity provider. They execute it. They then route it to where they need to with the prime banks, and each level of that routing, a cut is taken. So when you get to the retail level, that's why you're getting charged $7, $10, $8, $9 per lot traded, because the markup has already gone through. If you go to a prime of prime bank and you have 200 million or 150 million, you can go to a Barclays or a Credit Suisse and say, hey, I want to trade directly with you. Your gold spread, as an example, is 0.6 pips, 0.5 pip, where the normal spread on an ECN account is anywhere from like 1.1 to 1.6 pips.
I see. So is that where hedge funds come from? You have to work directly with a prime of prime or a prime bank?
You work with that at an institutional level. You're working with a prime bank, and you have counterparties that have accepted the risk because they manage that balance sheet, and you get super, super tight spreads, super executions, and that actually helps your overall bottom line. So it's not the retail broker that's trying to screw their clients. It's the chain of money, basically up and down the chain. At a retail level, retail traders, we have the worst trading conditions known to mankind. So the only thing that you can do to avoid that is, run a fixed API, try and get a custom terminal built, really, try and avoid all these little latency issues and things like that so that you can compete, and be somewhat profitable.
So if there are breakpoint sales to the larger,
Yes.
so if there's breakpoint sales for every million of of volume, does that incentivize larger brokerages to have an advantage in the market by being able to have a cheaper, I guess I would say cheaper liquidity? Is that how you would phrase
Yeah.
it?
So you'll have larger brokers that will give you better spreads because they're getting better cuts at that rate too. There's
Are
some
there
brokers.
conglomerates? Sorry, are there conglomerates in either the
Yes.
liquidity providing world or in the
Yes.
brokerage world?
Yes, a lot of liquidity providers are coming out of Dubai now. There's a big conglomerate out of the UK, Europe, and those are the real meccas of liquidity providing is out in those areas. And chances are a lot of brokers are using the same liquidity providers. There's just variations of it. Because what happens is, as a retail trader, you start to, it's natural curiosity, right? So you start trading, you're like, man, I'm getting screwed over. This sucks. I hate trading. I want to be the house. So now I want to run a brokerage. And then you're like, holy cow, I'm getting screwed even bigger. I'm getting screwed over more than I was when I was trading, because now I have this huge liquidity provider that's basically killing my business, because every time they do a spike in the market, I'm the one that gets the emails and the phone calls going, well, you're a savage broker. You basically whipsawed me out of my account. I want my money back. You're cheating me. And it's like, oh my God, no, it's not. It's this guy. And you call your liquidity provider and he says, oh yeah, we just had a bank leave the liquidity pool. They moved all their funds out. And it's like, oh, wonderful. So that just moved the market. Yeah, sorry about that. Okay, well, what can you do to fix that? Okay, well, you know what? We'll refund the trade. We'll adjust that because obviously we don't want your clients pissed and we want to keep your business. But if you're a brand new brokerage, good luck trying to have that relationship with your liquidity provider. They're going to be like, hey, we don't care. Prove to us that you're going to stick around, and then maybe we'll help you. And
Wow.
that's the biggest problem with the brokerage industry is you have to prove yourself before you get to that point. But you almost die proving yourself. I remember the first 6 to 8 months I was running a broker, I was bleeding, hemorrhaging, because it's like, guys, you're screwing my clients. Oh, we don't care. Oh, what are you going to do? It's like, you want our flow or not? And it's like, well, yeah, I guess I need it because I need people to take orders, and I need to put orders into the market. And now it's like, oh, you guys are really big. And it's like, yeah, okay, well, you know what? I know 3 other liquidity providers that will give me better rates. Are you going to match them, or am I moving? Oh, no, we'll match them for you.
Wow.
And then, so the relationship starts to change because now you are part of the bigger fish. You're an established broker. Similar to trading, 90%, 80% of brokerages fail within the first year.
Wow. Okay. I feel like I can keep asking you questions because
Yeah.
I have more questions
Okay.
about like different liquidity providers and different tools, but I feel like we'll save that for the next talk. We'll let people digest some of this information, and I'm going to put out a small schematic about the flow of money in the markets,
Hmm.
and hopefully we can post that below this.
Yeah.
Ted, thank you so much for getting on,
No
guys.
problem.
This has been probably the most insightful interview I think I've ever done in my life. Go back, grab a notepad, take notes. Ted, these are kind of the highlights of my week, these conversations, because I get
Yeah.
so much insight on the markets. Everyone knows how much I love the back end stuff. So I
Yeah.
appreciate you stopping by.
No, I mean, I think it's important. I think it's important for us to lift the veil when it comes to the back end of certain things, so that as a group, we're more educated and we keep different organizations accountable to their actions. And I think that helps to change the industry and the landscape. And suddenly, understand, like talking to an owner of a broker or talking to an owner of a liquidity provider, it shouldn't be some mysterious thing. Like, it is what it is. People need to
Mhm.
make money, but we can all make money fairly if things are done, with proper rules and, proper things in place to help benefit everybody.
Uh, and there's nobody in that better position because you are in that position, and having the perspective of that transparency, which is, yeah, we can all make money, but I can at least let you know what my system is. That's really
Mhm.
important because I feel like for the most part, there is a veil over the back end
Yes.
stuff. And so
Yes,
I
there
really
is.
appreciate you getting up and clearing the air on that.
Yeah, no problem. I mean, I think it's important. I think, you know what? I've always said, if you run a broker, you're making tons of money. Your idea now is to make sure you keep your clients happy, because the more they trade, the more money you make. You're not trying to rip your clients off. You're trying to make sure you give them the best and favorable trading conditions that you can to increase your client base. And even myself, I reach out to other broker owners to speak to them about things. I'm friends with them. I'm not in competition with them from an evil standpoint or a malicious standpoint. Obviously, we all want clients for our platforms, but it's nice to be able to talk to somebody and say, hey, did you experience this? Or, what's happening with this
Mm.
liquidity provider or this bank? What have you heard from them? At that level, when you're working at that business, it's nice to have those conversations. These aren't conversations you have with retail traders, you
Mhm.
have at the higher level, but it's, that's the way the landscape is changing now. There's more transparency. Brokers are starting to realize they have to value their clients, not treat them like trash. And you'll see over the next couple of years, the trading conditions are going to get even better. There's going to be more competition, more brokers opening, and it's just better for the retail trader. It's healthier. And if you're doing a positive job as a broker owner, or you're, maintaining transparency, you've got nothing to worry about. You'll just continue to grow.
All right. Well, we have something to look forward to. That sounds
Yeah.
amazing. Ted,
Mhm.
a lot of people are going to watch this on a Sunday. They're starting off their trading week. Any quick tips you have for the people at home before they start their trading week?
Yeah, so I mean, take a look. First of all, Monday is obviously a holiday in the States, so we're probably not going to have that much activity. I mean, I always say that, and then a whole bunch of stuff happens. The other thing is, too, always keep in mind, we're heading in towards the end of the week, or sorry, the end of the month, the last week of the month. So as we start to move there, think about what the higher time frames are doing, and you can compare that to your lower time frames. How does the end of the day finish usually on the higher time frames? How does an end of a week finish? And now how does the end of the month finish? So you might find this week's conditions might be a little choppy. You might get impulse moves as people exit for the month end, or you might
Mm.
get moves the other way as people enter the market. So when you start to tell the whole story, keep that in mind, because you might find this week might be incredibly difficult for you to trade, or it might be incredibly easy. And what you can start doing is, as you back test, you would say to yourself, hey, we're coming towards the end of the month. There might be a whole bunch of pullbacks on
Mhm.
pairs that were bullish. There might be rejections on pairs that were bearish, because the monthly candle is coming to a close now. Similar to, when you look at a 4-hour candle, the last 15 or 20 minutes, sometimes there's a massive rejection or a massive pullback because we reached a key level. So this is something to keep in mind. Look at your targets for this week on the daily or the 4-hour time frames and say, hey, we're coming to a monthly close, a weekly close, a daily close. Those could be some key levels that we may not break this week. But then as we start the following week with the new month in June, that's when all those levels break. So, plan yourself accordingly. Understand that the market's going to move in a wave, and we might have a pullback this week where you're going to get slaughtered. And if you just waited another week, you would have reaped the benefits of the actual move that you were looking for.
Ladies and gentlemen, chart addicts at home and all around the world, you guys heard it first from Ted. We'll include all the links below to how you guys can connect with Ted and how you guys can connect with us. Any questions you guys have and any comments, please leave them in the comment section below. Ted, thank you again for stopping by the Expert Trader podcast series.
Yeah, definitely. No, my pleasure. And thanks for having me again. It seems like it's going to be a regular occurrence.